Okay, good morning, Trader First Year. This is the 2/19/2021 morning forecast. Markets are implying a move of 1.33% plus minus up and down on the S&P 500. Markets have realized a move of 1% plus or minus up or down. The difference between what market makers are implying and what has been realized has widened. The spread increased to 7 basis points. The put-call gamma imbalance is skewed towards short-dated calls on dip buying. However, a widening spread increases left tail risk and spikes in realized volatility upside. Realized volatility has stabilized, but recently has dropped below 16. This is favorable for a continued melt up. The S&P is expected to move close to 1.27% up down this week, which means the S&P is likely to remain 13% to 15% above its 200-day moving average, which is 3,402. Weather disturbances due to Arctic air, polar vortex continue to weigh on the Midwest, Southwest, and Southern states, which negatively impacts growth in Q1 2021. Forecasters were expecting nominal growth of 300 billion and real growth of economic output of 130 billion for the first quarter of 2021. I suspect inclement weather is likely to shave off 30 to 50 billion in economic output nationally. Weak non-farm payrolls, along with slowing growth in real GDP in the fourth quarter, are key economic indicators to pressure growth in the first half of 2021. However, a finalized fiscal deficit package of 1.9 trillion via reconciliation in Q1 2021 is expected, which is a significant tailwind to nominal growth in the second half of 2021 and first half of 2022. This assumes virus cases come down and pandemic flare-ups lessen. Larger fiscal dissavings increases capital inflows to finance very large twin deficits, which should put upward pressure on the US dollar and downward pressure on corporate and government bond yields. Dollar appreciation dampens inflation and should lead to temporary transitory base effects. Inflationists and inflation fear-mongers engaging in scare tactics are likely to be proven wrong. However, there is some base effect short-term transitory spikes in inflation data from February, March, April, and May. Markets' expectations are split, but I suspect the Federal Reserve will look through these spikes. Political risk has diminished in the first quarter due to reconciliation, but it has increased in the second half of 2021 and first half of 2022, which may pose risks to much needed investment spending on infrastructure, human capital, and research and development. So I view the medium term as tilted to the upside due to potential gridlock. Following this weekend's congressional failure to hold public officials accountable, lone wolf domestic terrorism risk increases. Congressional cowardice is being viewed globally as a significant sign of weakness and disorientation in Western democracies. This increases foreign terrorism risk. In my humble opinion, it endangers all 330 million Americans, regardless of political affiliation. Negative labor data fosters a rise in economic uncertainty. Vaccine distribution priced into Q3 2021, but distribution obstacles have increased and efficacy for herd immunity will be closely watched. Details are currently unknown. The market is currently pricing in an additional 4% move, plus or minus up down, by March 19th. The S&P 500 could potentially trade as high as 4,084.08 and as low as 3,775.61 by March 19th. The VIX is expected to move 7.61%. The VIX is currently 22.14. The VIX price range is 23.82 to 20.57. The Skew Index is extremely elevated, which indicates market participants are paying up for catastrophic protection, 2 sigma events. Stocks continue to offer investors the highest real returns. The nominal yield on equities is 4.5%, while the nominal yield on 10-year treasuries is 1.27%. Real yields on all tenors of government bonds are decisively negative, while real yields on U.S. equities are positive. Disclaimer: with realized volatility rising above 12, there is a larger risk of systematic, highly leveraged short vol strategies like equity vol targeting, trend following, and risk parity positioned for a sell-off and reduction in market exposure. The potential for a much larger delayed sell-off of 4% to 5% is coming. The March-April VIX contracts at 25 and 28 are still underpriced. They should price near 39 to 47 in my humble opinion. I strongly believe February 2021 could replicate February 2018. However, I have been wrong before.